Good morning, ladies and gentlemen. Well, according to my calculations, the risk dial is in negative territory again, around the -10 area, which is not dreadful, but it's not good. I am very worried about what bond yields are doing, and we will look at that. But just a quick word to say that we're very close to getting the site back up fully functional. I would have thought another couple of weeks. And then we will have a much better site with many more instruments being covered. Having said that, let's have a look at what bonds are doing. Several weeks ago, I started saying to you that the yield curve is going to be absolutely useless in this time period at predicting moves, and so it has come to pass. I really would not give too much credence to what the yield curve is doing at the moment, because basically you are getting waves of selling in different tenures of the yield curve at different times. Does this move in 2s10s from negative to positive into the 30s mean that we are going into an expansionary period? Absolutely not. You're getting illogical moves, and they will continue to be illogical until we get to around this area, which is 54, 55. I'm not even going to think of fighting the yield curve or doing anything in it. But I think at this kind of area, the likelihood is that we go back down. I think we're now in a big range, which is probably not predictive at all, and only at extremes do you fight that range, and the extremes will be up here in the 2s10s around the 55 area. The same applies for the 5s30s and for the 5s10s. This is a weekly chart of the 5s30s. I think it can probably come all the way back into this kind of area, 38 basis points, and that's where I might think of doing something, looking for more flattening. But that's, it just has no predictive capacity at the moment. It's just reacting to what people are selling at the time. And this is 5s10s. I think it can probably come back down to here, to 13 basis points, something like that. And only there will I start thinking of doing anything on the flattening side. If we look at the individual tenures, the trend is unmistakable. The trend is, higher rates. I honestly thought that at some stage we would calm down and just wait for the Fed to catch up, and that's going to take weeks and weeks and months. But we're just not doing that. Okay, the 5s didn't move last week. In fact, they stayed in a very, very tight range. And if we enlarge this weekly chart, we can see really that this area up to 299, 3% is really, really important. We haven't been higher than that for a decade, and it's going to be quite tough to break it. But I'm beginning to think that we are going to try to break it. So that is, and that is the part of the curve that's least bearish. So we'll leave that alone, and then we'll look at the 10s. The 10s are basically catching up. This is the weekly chart, and we are going to 298 to 303, which is, as high as we really got, apart from a couple of, a month here. But this area is going to be really, really important. We are going with, this is the 1.38 extension. If we start going through there, then things are really bad. And the one that really worries me most, and I will explain to you with a narrative or how I would set up for the auctions, this is the 30s. The 30s are the most bearish. The curve is steepening, and really there's nothing to stop the 30s going to 322. that kind of area. And you can see that every time it's touched this 294, it's actually gone to 322 and spiked. And if this is an ABC correction, we could easily get it even to 350. Well, that level is 346. So the curve is steepening. The predictive capacity, as I keep on saying, to me is nil, but that it just shows me that people are keep on selling bonds, and they keep on seeing no value in long-term bonds, even around this 3% area, which is very worrying, because when that happens, accidents happen. And this is why I'm so worried about the 30s spiking quite a bit further. I want to explain to you how I would have set up for the 30-year auction and what I would have expected as a trader who is trading 30s to happen. This is Tuesday, this is Wednesday, and this is Thursday on a 10-minute chart. This trend was perfectly understandable because everybody wanted to set up for the auction starting in the 3s, then the 10s, and then the 30s. So everybody was basically setting up shorts. They started covering a few shorts on the first auction, and then this was the 10s. So everybody started covering their shorts for the 10s auction, which happened here at 1 o'clock. And this is actually perfectly understandable move down. This is exactly what I would have done. I would have started shorting bonds here in preparation for the auction the next day. This move, therefore, is perfectly understandable, and now is what starts getting silly, because here I would have already got indications of what the bids are going to be like. Have I got good bids? Yes, I cover my short. Right, the market comes here, and this is exactly where the auction takes place. Okay, the auction takes place at this level, at this time. Now, I would have expected that once the auction was over and we are over these previous levels, the market to continue up, because the auction is over, the dealers got very little of the auction which they need to sell, and basically anything that's left over with the dealers would be sold a few ticks higher, because the dealers don't want the risk. Okay, so it didn't go particularly well, but it's over, so we're going sideways, we're going sideways, we're going sideways. And the dealers all the time are lightening up on anything that's left on their own books. And all of a sudden, bang, we get this has to be selling. This has to be selling from A, big retail, or B, people who bought the auction. Everybody bought here, and now all of a sudden they don't want it anymore. This is not what tends to happen in a healthy market. In a healthy market, we would have continued to go up slowly, as this supply was digested by strong hands. This means that the supply is in weak hands. We bust through the lows, and basically there's no rally. When this tends to happen, this means that all the holdings are in weak hands that need to hedge and don't want it at these levels. This is a continuation move, and really I would expect bonds to go down at least another two or three points next week before we get a bounce. That's why the Bund strategy failed, and we'll look at that. This is not what happens in markets which are even stable, let alone bull markets. I mean, nobody thinks that this is a bull market for bonds, but at these yields, I really thought, and we can go back to have a look at where we are on the weekly levels. I really thought at these levels we would be, if we enlarge that at these levels, we would have some bids and we could go sideways for a few weeks. Don't forget, this is a weekly chart. I would have thought that we could have stayed here and waited for the Fed to do something. But no, it looks like absolutely not. Things are just in a continuation phase. And that is why I think the likelihood is more likely than not that over the course of the next couple of weeks, we see this 322 area. And this is the, to me, all-important chart of TLT. I want to see 115.26 before I even think of buying. In fact, at 115.26, it's going to be, I think, a wonderful time to do options, because either we stop there or we are going to go all the way down to par, and that is a 15% additional move. So either we are in the 115, 127 range, or we are going to go all the way down to par and probably all the way down to 90. That level at 115.26 is where basically you buy 3 to 6 month straddles, because either we're going back to 127.37 or we just fall apart. In Europe, you can see the same steepening trend. This is the Schatz. We've done absolutely nothing all week. When the ECB came down and basically came out, and basically said, we ain't doing nothing here, we came back and did a doji on the weeklies, nothing happening here. But the yield curve is definitely steepening. If you look at the fives, that is higher in yield by about, 5 basis points. And you can see how pivotal this area here is in the fives. This, what is that, 64 basis points. And the one that's really worrying again now is the bunds, because we are likely to go to all the way to 110, if I'm right about the bonds. It's just very worrying and very disappointing. I expected this kind of action or this kind of action. We could still get this kind of action, but we can't get this kind of action. What I expected was retracements, basically staying in a range until we get the ECB and at some stage going through. Obviously, what the market is saying is that it doesn't believe that the central banks are going to have this inflation thing under control. And really, the reason why we wouldn't is this. This is now the chart of the five-year forward inflation expectations. If we start breaking, and I will be watching this like a hawk next week, if we start breaking above the highs that we've had basically here, we are likely to be in a world of pain in the 30s, and same thing is visible here in the 10-year break even. If we start breaking through this 295 level, I think the 30s will go to 320 in a big hurry. And that has consequences for all other asset classes. Basically, I'm very worried that we're going to get a spike in bonds. And I think the likelihood is it's basically more likely than not at this stage. As US yields drive higher, so does the dollar. We are likely to get spikes, aren't we? Even in this. And that is my theme this week, spikes. Where could we go? Well, at least to 100 here, these levels here, which were highs, 100 and 170, but probably over time to 102.82. There is absolutely no reason to sell the dollar. The differentials, the yield differentials, the fears over Ukraine, the need for dollars to buy oil, all these things are basically driving dollar demand. I just can't see anything that's gonna give us a rapid turnaround from spike levels, quite possibly, but from these levels, you know, these, if we come back down to 99.83 or 98.81, that is just a reasonable, you know, retracement to go higher. Even if we look at the dailies, I mean, it's, the trend is not parabolic, is it? I definitely expect over the course of the next couple of weeks to see this level just short of 102. And if we change that to Euro USD and we look at a weekly chart, really you have to test this previous closing week, which is around 106.94, just underneath 107, and probably this these lows around 106.40. It's just likely to happen. I mean, the markets, when getting so close to the previous lows, like to take out all the stops that are in this area, even if they're going to reverse. So, you know, likelihood of us not testing these levels seems very slight to me. For a market that has the US dollar and bond yields so much against it, and gold being the derivative of them, it's not surprising that we are not in an impulsive phase in gold. But what is interesting to note is that it just will not close below these previous highs around 1912. It's very well supported, and I'll show you some spreads later on which indicate how much gold is outperforming TLT. So here we go. I would have thought that slowly we will just ascend, and I'll enlarge this chart to around the 2045 area and retest it. I think it might take a while. I think it's not a, as I keep on saying, it's not a market to buy and forget, simply because at some stage when if the bond yields spike, you are more likely than not to get some decent selling in gold, and you need to buy it on on the dip after the bond yields have spiked. Because once they've spiked, they're likely to return, and that will be a good, you know, sort of tailwind for gold. But I fully expect it to basically do something like this. Try all the way to 2045, get a couple of nasty days back down towards, you know, sort of the 1930s. And then go again slowly. But it's interesting to see how much actually it's outperforming other asset classes. And this is a chart of TLT over GLD. And you can see that we are coming into the relative all-time lows. Don't forget that TLT naturally has dividends and gold doesn't. What is interesting here is this is the level that when it broke down, I said, be very careful of bonds. And this was back in 2021, late 2020. And here we are, you know, 2 years later. You can see how important these spreads are, these weekly spreads. 2 years later, we've made a, you know, almost a 30% move, relative move. To me, this kind of chart is a continuation chart over the long term. I mean, this is years. And basically saying that at some stage we're going to test these levels and people are going to panic on the downside. And that's another reason why I think that that gold is a better asset to hold at the moment than bonds. That is another reason why I think that we are likely to see a spike in bond yields to that 320 area and just basically go down and test this at the lows. The other chart that's is suggesting it is this is ACWI, so basically the totality of the stock market and over GLD. We are beginning to roll over, and really I would not be surprised if we tested these levels. And if we do that, that means that the stock market reacts, or high beta stocks react to a spike in yields, and gold reacts less. But to me, everything and every asset class and every spread is pointing towards the probability that we are having an accident in the bond market, which has its consequences on other asset classes. What could cause this accident in the bonds? Well, it could be DBC, couldn't it? It could be CL, which is the largest component. This is very strong price action, okay, in the weeklies. I think now we are quite likely to go up to this 29.73 level and test it. And what is interesting to me is that basically this is the GLD over DBC chart. It's coming into my area, which basically says at some stage you've got to prefer gold rather than DBC. And what that is suggesting is that if the DBC goes up, gold is going to keep parity with it, and that suggests that those 2040s, 2050s are going to be seen in gold, while the bonds do something like go to 330. So that is what these charts are suggesting. And also DBA, and this is the weekly chart in DBA, it's breaking to new highs. I would have thought that even the agriculturals are going to be seeing 24.20, so that's a 10% move from here to there in agriculturals. And really, if you've got food inflation, if you have oil inflation, all these things suggest that we are more likely than not to have an accident in the bonds. If we go to CL, this also is strong price action, because all we've done on the weeklies is basically done a bull flag and come back to where we broke out from in the Bollinger Bands and never really closed below this 97.77 area. We should really test 110.53, and if we go and close above 120, that I'm sure is going to be enough to cause an accident in the bond market. I also wanted to show you a weekly chart of copper. Copper is not leading at the moment. In fact, it's been doing nothing for the best part of a year, been in a range. But these are the highs, 5,055 on a closing basis. If we start retesting that level, that is more than enough to cause the bond market to take fright. So, everything I look at is saying that the likelihood of getting a nasty move in bonds, which basically breaks the system, is higher than it ought to be at this stage. Because let's face it, if the Fed is now aggressively hiking, bonds should be assuaged and not as worried about future inflation as they seem to be. What the market seems to be saying is that this inflation is going to be worse and more persistent than we thought only a few weeks ago. and that therefore the Fed might have to go through neutral, actually restrictive, and cause some kind of a real slowdown in the economy, which would be reflected in equity prices in terms of some kind of a recessionary expectation. And yet there is absolutely no sign of any kind of fear of recession in the Blue Angels. The earnings, although we are now, approaching the height of earnings season, or rather we've started earnings season in a couple of weeks' time, we'll have the height of it. These forward earnings expectations keep on going higher. What does that suggest? That suggests that even if the market heads down because the bond yields are scaring it, it's likely to be caught by this times 18 forward angel, and that we're going to bounce around with using the times 18 forward angel as a bottom. It's very unlikely that we start making lower lows until at least these Blue Angels, the forward earning expectations, start flattening. Then we can have a real growth scare. That takes a little bit of time. So for the time being, I'm content to think that the lows that we've seen in S&Ps are going to hold it. Over the medium term, I'm not so sure. It's clear to me that in the equities, you still want to be playing defense at the moment. Last week, basically, we stayed exactly in the range that I thought we would. We can't go higher than 44.79, and we basically held in above 43.88. We held that range, but these Bollinger Bands keep on opening up. The major moving averages keep on rolling over, and the likelihood of an accident and us going at least to 43.17, but quite possibly to 42.55, which would be that times 18 area, okay, would be here around 42.55, that times 18 on the Blue Angels. I think it's more likely than not, and especially if we look at the daily charts. We've stayed here now. Whenever these Bollinger Bands contract like this, that means that the move that happens is going to be a continuation move and persistent, and it takes you down towards this 42.55 area. That is, to me, more likely than not. I think any rally up to the 44.79 area, or sort of even slightly higher, I don't think we're going to get anything higher than 44.79, and then we are basically going to be trading in this area here, where I think the support is the real support from the Blue Angels, the forward earning expectations, and really if we get a bond scare, we are likely to be in this area here. The fact that NQ seems to be the most vulnerable chart suggests to me that it will be because of bond yields. Look at how tight we traded last week. We just couldn't even get back to the close of the previous week. This, and the fact that we are just opening up these Bollinger Bands and that this moving average is rolling over at this speed suggests that we just basically test the previous lows. We have a gap here, a closing gap, down to 13,000, and let's call it 13,000. This to me is the likely path, the more likely path to fill this gap. And given that NQ is the most vulnerable, and given that I'm afraid of a spike in the bond yields, that actually means that, that's the reasoning why NQ would lead the move down and why SPX would go down to the levels I just showed you. But the interesting thing is also that if we look at a weekly chart and enlarge this area, this is precisely the kind of level that you would expect to see, and where the support is around the 13,000 area. You can see all these secondary highs and lows and all these spike lows. This is the area that we are more likely than not to see within the next couple of weeks as support. I wanted to also show you a 195-minute chart of DJI. The Dow Jones is actually the one that's reacting the least, i.e. the one that's doing the best in terms of holding in. But even that one is rolling over. You have the 200 period moving average coming down, and every time we go up and test it, it gets sold. So the fact that even the strongest market, and don't forget that this area is where we're trading when the S&Ps were roughly around 4,600, 45, 30. This is where we were. So basically the S&Ps have come down over 100 points and the DJI has done nothing. That shows you how much weaker the NQ part of SPX is. But even the fact that the strongest market is still dominated by a descending moving average tells me that the downside eventually is going to be the weaker side. And if it's going to be the weaker side in DJI, it's likely to be that much more pronounced in NQ and SPX in the middle. And even IWM suggests that basically we're retesting the lows. I just can't see, IWM basically got to the levels that I had for the 195-minute chart and the weekly chart and could not close. To me, this was a real big tell that we couldn't close above 210.63. That suggests that we held in last week. At some stage, though, we retest these levels around the 190 and a half to 189 and a half. I think that's more likely than not over the course of the next couple of weeks. The fact that equal weight consumer staples over discretionary is basically at the lows, and this is where we were when we were trading 4,200 in the S&Ps. This to me suggests, but as long as we stay here within this area, they'll suggest that we are in a defensive stage in the market. But if we start breaking down through there, it might develop in a full-fledged growth scare at the very least in SPX. So even this spread is basically saying that the likelihood is that we retest lower levels. What I am afraid of is that we don't really have much support below these levels in SPX. Then we could have a 2-3% move, which is quite quick, but which is another buy for a retracement of about 2%. So really, what every spread that I'm looking at, and everything else just basically says you have to trade levels. You have to be very patient. Don't just trade for the sake of trading. This is not one of those periods that will let you out of jail with a get out of jail free card. You could get really hurt here. The one market which is not raising the alarm is actually volatility. And this could be because we've got a long weekend and everyone was basically selling options to get the theta out of it. Could be, okay. This 200 period moving average, 200 daily moving average is now acting a very good support. We trade it every day, it seems, or above it. The one thing that I will tell you is that we have this back gap up to 35, closing gap here. I can enlarge this area for you. And, you know, you can see it here around 35, 35.10. I know that we're going to fill that gap. Okay, I just know it. Whether it takes another couple of weeks or not, neither here nor there. But this is what volatility does. To me, actually buying some volatility or volatility calls over the course, you know, something 1 month volatility calls struck at 30, they'll probably going to be quite cheap, or even struck at 25, is going to be probably profitable and something that I'm likely to do on Monday. If some kind of scare comes, it's logical to think that it'll come from Europe. And this is a very long-term weekly chart of the stocks. And what is really interesting to me is that 38.43 on a weekly closing basis seems to be a really important pivot. I'll enlarge this for you so you can see the one time that we closed above it, we never looked back and stayed above it. And since we closed below it, we can't close above it on a weekly basis. This to me suggests that we go down and retest at least 36.45, and more likely than not, this kind of area around the 34.75. It looks like it really will pay to play defense in Europe for quite a few weeks yet. But, you know, 38.43 is the level. So you're not having that much risk if you buy puts struck at 38.50 for a few weeks. You know, as the market, if the market rallies a little bit, I would have thought you'd be able to get out here around 35.50. You know, even if it gets only to 36.45, it'll be quite profitable. And basically all the equity charts are beginning to look the same. 200 period moving average, 200, you know, lots of moving average. Everything is, you know, it's rolling over. Everything is saying that these spikes to the moving averages and to the levels are very, very good sells. Or better sells than buys. So basically all the charts are saying it's still time to play defense in equities. And with that, here are the levels. I'm really afraid that these levels might be seen, and you know, it's going to be quite worrying when we do get there. Or if we get there. So I really have no reason to believe that the effect on equities is not going to be this. So here we are. We have all the levels. We know why we think the bond market is going to spike. There is absolutely no demand out there. I mean, I haven't, you know, I've traded bonds for a long time. And I haven't seen a reaction like that after an auction for quite some time. And every time it's happened, it wasn't good news. So that is what I'm afraid of. Let's see what happens next week. I'll tweet you on Monday. Have a wonderful Easter holiday.